Welcome to the weekly mortgage market update for the week of August 13th, 2018. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you your update. Well, last week we did see mortgage rates move lower to end the week. Take a look at the bond chart on the screen. You can see mortgage bonds hit on August 1st, floor of support, and have been able to bounce off of that and rally higher. So they moved into a tough trading channel last week. They were able to break out of that trading channel on Friday with some issues that were going on in Turkey and their currency, but we did not break above the 100-day or the 50-day moving average on Friday. We were still capped by that. So that's been a strong overhead ceiling of resistance. We've broken above it once or twice, but haven't stayed there. The next day we usually fell right back below. So with the move higher on Friday, with the bonds move lower in interest rates, we had a flight to quality because of what was going on in Turkey, so buying mortgage bonds and treasuries. But without breaking above that 150-day moving average, that means that's a tough ceiling of resistance. So we're going to recommend locking your mortgage rate to start the week. We think you're going to see the best rate you're going to see in a while. Unless something else drastic happens in the world, it's going to be tough to break that ceiling resistance. So go ahead and take the little gift you got on Friday, lock in your mortgage interest rate to start the week. Now, if we dig into the economic news, the stock market moved lower on Friday, which boosted mortgage bonds because of the political concerns in Turkey. Their currency has dropped 17% since the issue started. And Friday it was down, since Thursday it was down 12%, and it ended the day on Friday down 17%. So the concern is that other world currencies could be soon to follow because of the economic issues that could be going around in the world. So people are wondering, Turkey is the 17th largest economy out there, $800 some billion. They're wondering if it's going to turn into another Greece. But again, Greece had some issues in the stock market, but without resolving the issues in Greece, the stock market kind of just said, okay, Greece is what it's going to be. So then we had an issue with Italy. We saw a slight boost in rates for a couple days, and then it kind of went away. Not that the issue was resolved in Italy, the market just kind of accepted it. So the same thing's probably going to happen this week in Turkey. The market's going to accept what's going on in Turkey. People will move back into the stock market, which will pull money back out of bonds, and we probably won't see them break above the 100-day moving average. So go ahead and lock like our recommendation was. Now, we saw two measures of inflation. The producer price index for July 2018 was unchanged. From June, year over year, it actually dropped from 3.4 to 3.3%. Now, the PPI measures wholesale inflation, which does not always get directly passed on to consumers. Just like, for example, if they raise property taxes, it doesn't necessarily always get passed on to consumers that are paying rent, because market rent doesn't necessarily change because property taxes increase. So the landlord in that case just has to eat the extra cost. So just like with wholesale producers, when the wholesale costs go up, they can't always pass that on to consumers. So that's why wholesale inflation is not a market moving. Now, the consumer price index is, because that's inflation at the consumer level, and consumer spending drives the whole economy. So that rose 0.2% from June 2018, and year over year it remained steady at 2.9%. So 2.9% is it's the fastest pace of inflation in almost 7 years. So that is a hot number on inflation. That should have been bad news for mortgage bonds, but what was going on in Turkey overshadowed that, so that's why we saw the bond market do well on Friday. Now, we saw weekly initial jobless claims come out on Thursday. They showed a decrease of 6,000 claims to 213,000 claims for the week. The previous week was revised higher by 1,000 to 219. But these are ridiculously low jobless claims. It supports the unemployment rate of 3.9%. Employers are holding on to employees. They're looking for good employees to hire. So we're looking for wage growth, wage pressure, inflation to kick in here soon. And if that kicks in, that's going to be bad news for mortgage bonds. You can't keep having low unemployment and low jobless claims number without wages starting to grow at some point. When that happens, that will be bad news for mortgage bonds, so bad news for mortgage rates. Now, in the week ahead, we've got retail sales coming out this week, which is a market mover because that's a measure of consumer spending, so we'll keep an eye on that. The National Association of Home Builders is releasing their market index. They're also going to release housing starts and building permits. So we're going to get a good read on new home construction this week. Weekly initial jobless claims come out on Thursday, and then consumer sentiment index is also coming out on Thursday. So we got some good reports this week. We'll see how they move the market. Now in housing news, CoreLogic Home Price Index for June 2018 showed home prices rose 0.7% from May and are up 6.8% year over year from June of 2017. Now, even though 6.8% was weaker than the May number of 7.1, 6.8 is a solid home price appreciation. So this is an extremely good report, very meaningful. CoreLogic is also forecasting 5.1% price appreciation for the next year. So home prices are going to continue to go up because we've got we've got high demand and low supply. So with that kicking in, we should see home prices still appreciate. Now there are some pockets around the country being affected by the tariffs. For example, some of the real estate markets like San Francisco and all that have a lot of Chinese buyers. They're pulling back because of the cost of the currency from yuan to going into the dollar is making it more expensive to buy real estate here. So the tariffs have affected some states, but as a whole, real estate in the U.S. is still doing very well. Now, within that report, something shocking, 1/3 of millennials feel that renters feel they can't afford the down payment to purchase a home. Well, that's important because that's not true. It just means there's a big gap in education if 1/3 of all millennial renters think they can't afford a down payment. There's loan programs such as the Veterans Loan or the USDA Rural Housing Loan where it's 0% down. FHA is only 3.5% down. You can get a conventional loan for most people for 3% down. And if you don't have that, there's down payment assistance programs and grant programs to help you with that. So I think we need to get more education out there to millennial buyers that there are assistance for down payment and there's very low down payment mortgage programs. So that should not be a barrier to owning a home. And then in the local news, we've got the next free first-time home buyer seminar this Saturday, August 18th in Newark, Delaware from 10 a.m. to noon at the Christian Hilton Hotel. And then the following Wednesday, we are in Wilmington, Delaware, which is August 22nd from 6 to 8 p.m. at Independence Mall at EBXP Real Estate Office. You can register for either of those classes. Give us a call, 302-703-0727, or register online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.